We had a fairly strong week in the market with green pretty much right across the board, and we've also noticed that whilst we are sitting in fear, we weren't that long ago on the cusp of extreme fear, showing that investors are now gaining a lot more confidence, and perhaps over the next few weeks we may even enter into neutral. Now today we want to look at 6 top dividend stocks to buy near 52-week lows. Each one look incredible in terms of the upside and margin of safety, and the first one we're looking at is Novo Nordisk. They're a global healthcare company. They primarily focus on diabetes care, obesity treatment, hormone replaced therapies, and they also develop medicine for other chronic conditions like growth hormone disorders. Now, if we take a look at how they perform, they're down 26% over the last year, but over the last 10 years, they still have massively outperformed the S&P, up 279%. Right now, they are pretty much trading bang on their 52-week low, which is quite some way away, around 50% from their all-time high. Now, we also notice a double buy from both Seeking Alpha as well as Wall Street, and they also do pay a dividend just under the 2% mark. We also want to cover other metrics for each one of these companies, and we notice in the next quarter they are anticipating 28% growth to the EPS year on year, and if we look at the last 4 quarters, they've had 3 beats, 75% track record, which gives us some confidence they can hit their full year EPS for 2025, which in turn means their forward P right now sits at just above 20. That is below the S&P 500 as well as below their 5-year average. In terms of their growth, it does look fairly promising at an A-, year on year 26%, forward looking 22.5%, which is above the sector comparative at the mid to high single digit, and we also like the fact that the earnings per share over the next 3 to 5 years is estimated to grow 24% year on year, whereas the sector median sits a lot lower at 10.64. We also like their profitability that comes in at an A+, their gross margin at 85%, well above the sector at 58%, their bottom line incredibly strong at 35%, with the sector median losing money, -4%, and we also see they generate a ton of cash from operations, 17.66 billion to be exact, whereas the sector comparative, they are burning through cash, -15 million. We also like to point out a few other metrics for each of these companies. Firstly, dividend does look to be very safe with a 99 score. That is the highest score obtainable. We get the undervaluation signal, which we will show you briefly via dividend yield theory, and their latest dividend increase came in at a very strong 52%. Now, dividend yield theory tells us a company is undervalued when the current yield sits above the 5-year average, so 1.83 above 1.41 is a fairly strong signal, and we see that well below the 5-year rolling 21 versus 30.4. Now, whilst we do see a double severe undervaluation signal, we don't stop there, as we do put every single one of these companies through our own intrinsic value calculation, where today for NVO we get $117. That is derived from the DCF model, and as you can see, they essentially have the free cash flow year on year average at 11%, although the last 2 years have come in 22, 28, and based on that, with the discount rate, we get the present value of future free cash flows and terminal value, add together with the cash, subtract total debt, get to the equity value, divide by the shares outstanding, and as we can see here, $117, indicating 50% upside. Now, bear in mind, these numbers are subjective. You can grab a copy of this model by clicking on the pinned comment below, running through your own numbers, whether it's for Novo Nordisk or any others, but we'll show you for those that are more conservative, at 12%, that does give $102, 30% upside, and for those that are a lot more optimistic, at 16%, 134, indicating 72%. As always though, we do like to take through the median rate of 14, which as we can see will give us a very nice margin of safety. Remember, we kickstart the process, 10%, execute on that if it meets our 3 golden criteria: wide moat, strong financial metrics, good forward-looking data. If you believe that, a buy right now up to $105, then we keep going till it's near the current trading price, and right now for Novo Nordisk, not at the 35% level just yet, but you are getting at least 30% up to $82, and whilst Wall Street have revised their price target downwards, they still see, with their buy rating, $116 at the end of 2025, indicating upside of 49%. As always though, do give us your thoughts below whether you're buying any of these or maybe on the watch list. Today's video is sponsored by Snowball Analytic, and they are much more than just a portfolio tracker with a ton of features that you can use on the platform. We also like the fact their user interface is very easy to use, very quick to consume. You can see your portfolio broken down on a sector by sector basis. You can note which companies have performed very strongly that day, which are the top gainers or which are the top losers. It's also incredibly friendly for those who do love dividends. You can see a lot of information, for example, what is the yield on cost. You can see which companies are actually driving not just the dividend within your own portfolio, but also the growth, and also understanding whether or not some of the companies that you do hold have some risky dividends. It also shows you the average annual growth, which is very interesting to note. One of the cool features here as well is that you can compare your portfolio over long term against the S&P, and for maybe those that want a bit of inspiration about what companies they should consider, we also like the detail that it goes into for each company, not just the high level metrics, but you can take a look at the income statement. It also has information on the balance sheet, the cash flow, as well as many statistics which we do like to cover here on the channel. So you can click below, and the great thing is right now you can grab a 14 free-day trial. We then move on to NextEra Energy, which is a leading clean energy company specializing in renewable energy generation, including wind and solar power, and they also provide energy solutions through their subsidiaries Florida Power and Light. If we take a look at how well they've performed, well, they're up around 21% over the last 12 months. Over the last 10 years, they're up around 159%, not far off the S&P itself, and they're trading around the midpoint with a triple buy from Seeking Alpha, Wall Street and Quant, and a fairly attractive starting yield at 2.91%. If we look at their earnings, over the next 4 quarters, they are anticipating 3 of them to be growth, with a 100% track record over the last 4. And with December 2025 $3.68 EPS, that does give right now the forward PE around a 19.24 multiple. If we take a look at the growth grade, it is still at a B. Year on year, not the greatest, -4%, although the sector also -3. We notice moving forwards, anticipating 13%, well above the sector comparative at 1.7, and the earnings per share over the next 3 to 5 years, 8.31, marginally higher than the comparative at 6.5. Profitability also looks good at an A, gross margin 62 versus 45, bottom line 26 versus 13, and the cash from operations incredibly high at 14.2 billion, well above that sector comparative at 1.24. In terms of the company, well, dividend safety also very safe, but a 90 score, a double undervaluation signal, and their most recent increase to the dividend, 10% last February, meaning this February, just a few weeks away, we are expecting another increase. We can also see a severe double undervaluation, yield significantly higher than the 5-year, and forward P at 20, below the 5-year rolling of 27.3. So if we look at the valuation, it does come to $82, and as we look at the margin of safety today, you are pretty much getting a 15% at the $70 mark, with Wall Street seeing 23% upside, their price target $86 by the end of 2025, which, as we also saw, they do offer a fairly attractive starting yield at just under 3%. We then move on to Nestle, which is a global food and beverage company offering a wide range of products, including dairy, coffee, nutrition, and pet care, and they operate some of the most well-known brands in the world. We're talking Nescafe, Kit Kat, as well as Purina. And in terms of performance, down 28% over the last year. Over the last 10 years, they're up only around 5%, trading at their new 52-week low, with a double buy from Seeking Alpha and Wall Street, and a very attractive starting yield at 4.04%. In terms of their earnings per share, well, we should point out over the full year, they are expecting a marginal drop, which does give their forward P a marginal uplift to around 15.9. And in terms of revenue growth, they are anticipating, however, just fairly minimal. When we take a look at the actual growth grade, it does come in at a D- with -3.5 versus 1.7, and forward looking, they do expect it to be flat with the overall sector median at 2.1%, and we can see the earnings per share isn't looking great, 2% versus 7.4. One area they do excel at, though, is the profitability. They get an A+, 47% above the sector at 36, bottom line 12 above 4.3, and they also generate a significant amount of cash from operations, 19.1 billion versus 834 million. We also have another very safe score in the dividend at 90 with a double severe undervaluation, but last year we didn't really like the increase well below inflation at 1.7%, something that we will eagerly be anticipating over the next few weeks. And again, another severe double undervaluation. In fact, this is the highest yield they've offered over the last 5 years, and this is the cheapest they have been valued on a forward P over the last 5. And it does also feel good to know that whilst the yield is climbing very high, the dividend safety still looks to be very safe. And we also like the fact that when we run it through the valuation, you are getting a fairly attractive margin of safety. As we keep going, we can in fact see at least 15% around $82. Wall Street see around 21% upside. And as we mentioned, the dividend also looks to be safe with a score of 90. We also want to let you know we have released our latest free weekly article. We drop one every single Monday morning where we cover severely undervalued stocks as well as what's gone in the market over the last few days. So click below, you can sign up and read straight away, where you'll be able to gain access to 46 undervalued stocks for the month of January, the upside that Wall Street themselves see over the next year, and you can also grab a recently released copy of 43 stocks that Wall Street believe have the most upside in the S&P right now. So click below, you can sign up and start to read straight away. We then move on to Intuit, which is a software company that specializes in financial and business solutions, including products like TurboTax, QuickBooks, and Mint, and they help individuals and businesses manage their finance, taxes, as well as accounting. In terms of the performance, well, pretty much flat over the last year. Over the last 10 years, though, massive outperformance of the S&P, up 579%, trading near their 52-week lows with a buy signal from Wall Street, and they do pay a dividend, although on the lower end of what we have seen today at 0.69%. We like the fact that over the next 4 quarters, 3 of them they anticipate growth, and each one of them to be double digit. They also have a nice 100% track record, and if we look to July 2026, their forward P right now does sit around 27.4. In terms of growth, they get a B-, yet both on a year-on-year and forward-looking, they're sitting between 12 to 13, which is above the sector comparative in the mid-single digit. And we can also see earnings per share expected a 20% growth rate above the 15.6 that we get from the comparative. Profitability also looks very strong with an A+, gross margin 80%, sector at 50%, bottom line 18%, sector at 3.84, and we can also see a lot of cash generated from operations, 5.34 billion versus 96.34 million. They also get another very safe score in the dividend at 98. We like the double undervaluation, and we can see last August 16%, so strong double-digit growth. Whilst the yield isn't too far off the 5-year average, we can see the forward P at 30.5, well below the 5-year rolling of 34.6, which is typically an undervaluation signal, and that is also shown during our intrinsic value, where when we do take a look, we can in fact see not at the 20% level just yet, not too far off, but for this company, which we do believe to be high quality, 15 to 20%, with Wall Street themselves giving it 21% upside. And if any of these companies are one that you would like us to do in more detail, looking at the underlying metrics as well as other factors, do give us your thoughts below. We then move on to Elevance Health, which is a healthcare company providing health insurance and related services, focusing on improving health outcomes and affordabilities, and they operate through brands like Anthem, offering medical, dental, and vision plans. So if we look at this company, well, they have been hammered down nearly 20% over the last year. Over the last 10 years, up 174%, pretty much trading right there near their 52-week lows. We get a strong buy from Seeking Alpha, a buy from Wall Street, and they also pay a dividend, currently yield sitting at 1.69%. We do, however, notice over the next 4 quarters, they expect only one of them to be growth, and they have also missed in their most recent quarter quite substantially, but nonetheless, they do have a 75% track record, and we can see, based on the 2025 EPS, their forward P does look fairly low at 10.94. On the growth, they get a D-. Now year on year, 3.2 below 7.4. Moving forwards, a little bit lower at 6.4 versus 7.5. And we also know the same for the earnings per share over the longer term, 9%, sector comparative at 10.64. Profitability does look good at an A, whilst the gross margin does come under 28 versus 58. The bottom line does look strong at 3.7, when the sector median, again losing money, negative 4%, and we can see they generate cash in the billions, 2.13, whereas others in the sector are burning through negative 15 mil. We also like that we are 5 for 5 in terms of dividend safety, 99, again the highest score obtainable, a double severe undervaluation, and last January they increased the dividend at 10%, so this does tell us we are expecting another increase over the next few days. We can also quite clearly see a double undervaluation signal both on the yield as well as the forward PE, and this also translates into the valuation as we are getting quite a substantial margin of safety in today's episode for ELV, not at 30% level just yet, but you are getting pretty much a bang on 25% with Wall Street fairly bullish, $505 price target, that equates to 31% upside. We then move on to Canadian National Railway, the transportation company that operates a vast network of railroads across Canada and the United States, primarily focusing on the movement of freight, including goods like raw materials, agricultural products, and finished goods. If we look, they've also been hammered over the last year, negative 18%. Over the last 10 years, they're up around 50%, trading again right there at their 52-week lows, with a double buy from seeking alpha on Wall Street and a fairly respectable starting yield at 2.3%. Now, this industry is fairly cyclical, hence why we note 2 growth out of the next 4, and over the last 4, they have a 75% track record, which is nice to see growth over the full year into December 2025, which gives their forward P right now 18.1. In terms of growth, it sits at a D-, year on year up 1.5%, sector at 4, moving forwards pretty much flat around negative 0.8 with the sector at 5.2, and we can also see they do come in under in terms of earnings per share, 7.21, sector expecting 11.53. Profitability does look good though with the A+, gross margin 55% versus sector at 32, bottom line 32 versus the sector comparative at 6.55, and cash from operations looking very strong, 5.3 billion, again comparative a lot lower at 350 million. We pretty much have every company today with extremely safe dividend, this time a score of 97, double undervaluation with an increase of 7% last January. So again, similar to the others today, we are expecting an increase over the next few days. We also noticed that double severe undervaluation on the both dividend yield front as well as the forward P valuation, and we also quite like the margin of safety today. As we keep going, you can in fact notice a 20% MOS with Wall Street themselves and their buy signal upside of 27% over the next year, a $128 price target. And as always, do give us your thoughts below whether you're buying any on the watch list or for whatever reason they don't fit into your overall portfolio. Don't forget to sign up to the free weekly newsletter. We are dropping our next copy Monday morning. Grab those spreadsheets and come and join us in the Patreon where we do cover our weekly buys and sells. As always, have a great day and we'll see you all on the next one.